Hello everybody, it is the 28th of November 2010 and in this video we're going to take a look at the US dollar index as well as the silver market. So I'll start off with silver as well as the silver awareness contest giveaway update. Thank you for everyone who entered this contest. There will be another one in the month of December and there were 250 comments. Therefore, check the blog at the silverlog.blogspot for information on the winner, which will be announced on Monday. It will be a lottery-based system within the Dow Jones Industrials. Everyone will have a 3-digit number or 4 3-digit numbers. If your number matches, you will win 3 silver coins. And you can check the blog for more on that. So we'll start off with the silver text and then move it forward towards the US dollar index. And since this breakout in August into September, these gains were pretty small, 1%, 2%, even 3% moves a day. But price action was saying, hey, it's a nice gain going from 18 to 22. That's about 20%. Then on this candle here, the volatility was starting to go higher. That means the size of the candles were bigger, which means the percentage moves were bigger. And it got up to this 25 handle, sold back down to 23. And then it had this big breakout candle here in November, which moved it up to the 29 and 1/3 handle. Now, as far as the Fibonacci retracement, which is a indicator for picking tops and bottoms, or where you may find bounces or breakouts, that sort of deal, from this 18 handle up to 29 and 1/3, it came down to 25, which was the 38.2% Fibonacci level. It was also resistance on 2 different occasions, so therefore it was a successful bounce coming up to the 2790 level. And if you take the Fibonacci from this high and this low, this was a 2/3 or 61.8% move. It came down to this 26 and 2/3. That happens to be the 38.2% from this high and this low. So now we're in a trap situation where it has to decide if it's going to be bullish or bearish, because it came up to the 61.8 and sold off. On a bullish case, that's normal. You come up here, you sell off to usually a nice higher low period in here. Probably anywhere above 26 would be a nice higher low. And then if it's able to get up to this 28, it would have a better chance of breaking it out. Now, of course, on a bearish scenario, that would just be a bounce within the trend. And if it manages to go down to 25, then what would form is an inverted cup and handle formation. And really all that is where you make this high like this, and then the second one is lower, and then it repeats its neckline. In this case, the neckline is 25. So we'll wait and see what happens within that. And the fundamentals for it, if we do end up making these new low levels, 22, 23, even 21 area, then expect the premiums for these silver coins to go up massive. Because right now we are in a situation where coin stores are running out of silver. People don't want to sell, they want to buy, and for good reason. It's the fiat currency. Currencies are being devaluated, all this quantitative easing and such. Do you blame people for getting into silver because of that? And I say no, and that's why if we do have these movements, because all of these movements are from the COMEX exchange, from all these traders trading paper markets, then that's going to show a disconnect within Main Street. And we've all seen the disconnect between Main Street and the paper Wall Street markets. Moving on to the dollar index chart, this is a daily chart over the last couple of years. And when it had this significant gain and it sold off like this, that's a very, very bearish indicator. Because when you have a nice gain, yes, you need to retrace back, but to what level? And I think 80 would have been the key one. You come down to 80, it comes up here. At this point here, when it was going through this time consolidation, that was that moment. Okay, what are we going to do? Is this bounce going to be a just that quick little reversal bounce and then come in and make a higher low and go like this? Well, it could have, but it didn't. Obviously, it continued going lower, and since then we have now broken this trend line. But I really wouldn't lead too much into this as of yet. And I say this because from this high to this low, this is the 38.2% Fibonacci level, roughly around the 81 handle. And if you take the Fibonacci from this low and this high, it is the 61.8% here. So there's a lot of reason why we could have a bounce on the downside, or the market to go lower based on the Fibonacci values. To stay bullish, what you would probably want to have is some support at this 78 level, where previous resistance could become some support. And when we look at this on the longer term trend, going back to the 1970s, I want to focus on this 80 handle within this chart. Now, in the 1978 period, the dollar index fell to 82.07. It was an inflationary period. People were panicking, getting into gold and silver because they were scared of the currencies, going off of the gold standard. And, well, those who were awake at the time had good reasons. Now, they decided to raise interest rates, the Volcker rule, or Paul Volcker put interest rates at all-time highs, and the dollar went up to 164, the index that is, in February of 85. And as I was saying in the previous chart, when you have a big gain that sells off like that, it's a big caution sign. And the caution signs are still here. It comes down to this level here. That was above 80. Then it hits 80 here, goes below 80 in September of 92, hits 80 in here, and then bounces. So therefore, the 80 situation has a bounce, a bounce, a bounce, a bounce, a bounce. 5 different bounces at this 80 level. And then when it bottomed in 2008 at the 70 handle, it broke this 80 support level that was tested on 4 different occasions. Now, when you want to see trends reverse, you want to see support become that of resistance. Many times when support is broken, it becomes resistance. Many times when resistance is broken, it becomes support. Right now, 80 has not been resistance as of yet. First chance was here. It was not resistance. Then a dip below 80 in here. Second chance in here. That was not resistance. So now we are at our third opportunity for 80 to be resistance. And based on this pattern in here, where you go down, you consolidate for a little bit, what it looks like to me is that a wash out pattern seems to be following, because the odds are now likely that 80 will become resistance. Thus, it would mean probably a move not only below the 60 handle, but into the 50s. And what would this do for our global economy? It would put a lot of inflationary fears in the United States, and although other currencies would be going higher in value, when the United States goes through periods of fiat dollars going through a collapsing period, this is going to form itself into all the other countries within the world. Every single country, even though their currency against the US greenback would be going higher, it would also mean a lot of inflation, because when you look at inflation, just look at all the prices on the streets, whether it be for the food that you buy, whether it be for your energy, whether it be for your new automobiles, you name it, the majority of things are inflating. And one might say, well, houses are going lower in price. And when houses used to be 20,000 and 10,000 and 40,000 and have gone from 400,000 to 200,000, that to me says inflation is very rapid and rampant. And I think that if a move where this 80 becomes resistance would be extremely, extremely deadly for this market. Now, this is a long-term chart. This goes back to the 1970s. So this breakdown could take a couple years to happen, or over a year. But we're at the point now where if it manages to find resistance at this 80 level and head lower, things could get into some serious difficulties within the US index for the dollar. Thank you very much, and have yourself a great week. Bye-bye.